we are in many all over Canada, and we have a lot of very strong relationships. And most of the data I'm presenting today will be out of the Angel Capital Association. Along with Peter, I am on the board of the Angel Capital Association, and I'm in fact the marketing chair. Some overall, to set the stage on where we are. In 2016, over $24 billion was invested by over 300,000 angels in 71,000 in every single state in the country. And as I mentioned, they provide more than 90% of all of the dollars that go into startups. So we talk about how startups grow our economy. That money is really coming from angels. And it's coming in small pieces because the average check is somewhere between $10,000 and $50,000. The deals range, you know, one set of data will show you the deals are about 300,000, another one is about 850. It really depends. But again, sub-million is real common. And the valuations, this is the first time these companies are getting valued. You know, it is definitely a less than $5 million value. And one of the comments I make when I'm in startups, I'll say, look, I haven't even seen you build a business plan, and I'll tell you, valuation, if you don't have a profit and you don't have revenue, it's between $1 and $2 million. And they'll go, oh, well, it's this much. I said, no, it's not. It's between $1 and $2 million. So because you're doing this on assumptions, you're not doing this on hard data. You know, you don't have multiples of revenue when you're valuing an angel deal. And again, angel last year, and we'll see different numbers, they did $61 billion in only though 5,000 deals. Angels on the other side did $24 billion in 71,000 deals. Obviously a very different dynamic, but virtually all angel deals are either seed or early stage. With VCs, it's about half and half. And you need that original angel work to the VC dollars in most cases. The other really important thing for entrepreneurs, in particular entrepreneurs here in Colorado and many other states, angels are everywhere in the country, okay? When you look at VCs, they are in California, they are in New York, and they are in Boston, you know, with very few exceptions. And most entrepreneurs, when you talk to them, say, well, if I'm going to be successful, I've got to go to I've got to go to Silicon Valley. That's not true. Angels are everywhere, which means they're a lot more diverse in their thinking and in their ability to do deals. And it's a lot easier to hold of them because you don't have to fly across the country. Other thing, when you look at VC firms, and I'm going to be talking a lot today about diversity. I don't know how good the graphic is in your mind. There's about 900 active VCs in any one year. There's a lot more that are technically VCs, but investing in deals, as I said, in angels is 300,000. You look at those VCs and you look at the investing partners in VC, 89% plus are white men, okay? That's not what our country looks like, and that's not what entrepreneurs look like. So you get much greater diversity when you look at angels. It's not perfect, but there's a lot going on. And angels invest in almost any category you can think about, okay? They really are investing in startups all over the map and all over industries. If you're an entrepreneur and you think you've got a big idea that can get a return, you can find an angel that's probably willing to invest in you. Angels invest in many, many ways. Informally, on an individual basis, they meet an entrepreneur and they write a check. Most typically, and particularly starting out, and I'll show more data on this in a minute, they invest in groups. Why? Because working with other people, you get better perspectives, you get better due diligence, and you can get a better return. Accelerators are growing. They are not only helping entrepreneurs become more successful, but they are also providing initial funds. And often angels will get involved with the entrepreneurs. You just heard the request for mentorship because this is really one total ecosystem. Online investing is growing. It is not going to overtake the group of the individual investment. It is really just an additional platform. an additional way to get dollars. Often close around, we're seen as growing, but it plays a role in the overall system. And seed funds. Many seed funds, yes, they're seed funds. Yes, they might have the name of a nano VC or whatever. The money's coming from angels because it's another way to diversify. I mean, Peter, I would technically probably your fund is a nano VC, right? So there's all, these aren't hard lines. I probably should have done this in a variety of ways, but I just want you to know there isn't just one way or one answer as you look at this. Now, what we do know about angel investing, and this has been tracked over time, studies have shown that in order to have a successful return on your portfolio, on your investment, you must have a portfolio. Because basically, fewer than 10% of your deals are going to give you, depending on the study, between 80 and 90% of all your returns. So if you look at it as a bucket, you're going to have 10 investments. 5 of them are going to die instantly. Actually, about three are going to die instantly. Between 2 and 4 are going to have a slow, painful, agonizing death. 2 aren't going to die at all, unfortunately. They're just going to keep existing. A couple will give you a little bit of money, and then you're going to get one big winner. So the way angels are successful is by having a portfolio, and I'm going to talk a lot more about that because that's really critical. Okay, the deep dive is on who is the American angel. Talked a lot about angels, but you want to know something? Until just this past year, this stuff has been anecdotal, it's been qualitative, it's been very, very small scale research. And yet there's some really pretty basic questions here. Who are angels? How do they invest? Really, how do we invest? How do we become an angel? What's the story there? And what do they really want? What are they trying to do? So in order to answer these questions, last year, the Angel Capital Association, in conjunction with Wharton Entrepreneurship and Rev1 Ventures, which is a group in Columbus, Ohio, fielded the largest study ever of angel investors. Basically, we've got about just under 1,700 angels fill out a survey, self-report on these attributes. Wharton validated this and made sure it was really statistically significant. And this is the largest collection of angel information that has ever been out. And what you are seeing today is the first real overview of the study. We are just finishing it. It will actually be officially announced next week at the Angel Capital Association conference in Houston. So you get to see the first preview of some of this data. I will tell you there's probably one bias, I guess, in the data is the best way of talking about. Because many of, not all of them, but many of the people who filled out the questionnaire are members of the Angel Capital Association. Okay, it was much harder for us to get more independent angels. We hope we'll get them more this year. Although, on the other hand, we also want them all to be members of the ACA, so it's a little bit circular. A little bit of an overemphasis of groups. When you look at the terms of characteristics, it really is very valid, and Wharton has tested that as very valid information. First of all, let's talk about who are these angels, okay? There used to be an old joke that investors were pale, male, and stale, okay? That is definitely changing, okay? In the study, we've discovered that about 22% are women. And the more encouraging note is we looked at angels and we said, well, how long have you been an angel investor? Angels coming in terms of angel investing experience, it's growing every year. So that if you've been investing less than 2 years, about a third of women, about a third of them are now women. And in our own group, we have gone from actually having one woman member to now having about 30% of our membership women. And so a lot of progress being talked more about. It really has implications for the kinds of companies and the diversity of thought. The reason why you want to have diversity is not because it's noble or it's anything else. It's because you get better returns when you have a more diverse audience. Okay. Not making progress is really in people of color. Okay. Angel investing is still very much of a white game. Okay. And that is something that will only change by active attention, and will only change. And in markets like Colorado, where you have a very large, for example, Hispanic population or Native American population, this is a real opportunity because you've got bright people having bright ideas, but people tend to invest in people and ideas that look and think like them. So diversity is really important, and this is something that we've got to talk about, because if you talk about it, 5 years ago we were talking about women and there weren't enough women, and now we're seeing some very real progress in women investing. Racial diversity is still a major issue for us. Okay, age tend to be a little bit older. Median age is 59 years, and the age at first investment is 48. Okay, oh boy, that's old, and a lot of people in this room are a heck of a lot younger than that. Part of it is just a function of time. According to the SEC, you've got to be an accredited investor in order to invest in a lot of these deals. Well, to be an accredited investor, you have to have a net worth over $1 million outside your home. You've got to be earning XYZ dollars. It takes a little while to accumulate that wealth. As you accumulate wealth earlier, you can do it. And we are seeing a growth in younger angels and getting them engaged, and that's really important. Excuse me. We are also seeing that more and more people are coming into angel investing every year. We've got a good chunk that have been investing for more than 18 years. So that means they originally started investing pre the internet bubble, when all of that activity was happening, and probably what happened for a lot of them, the bubble burst, which is why in the age range of 10 to 15 years, weren't quite as many people coming into angel investing. That's also when we had the financial crisis, and a lot of people lost a lot of net worth and were a little. But we found post the crash of 2008, we are getting more people into angel investing. One of the issues is they figured out and that drive diversity and age. So how do you become an angel? Okay, we used to think entrepreneurs, angels made entrepreneurs, that you invested in a company, so therefore the entrepreneur could get started. We discovered angels disproportionately have MBAs, master's degree higher. Okay? And I bet there's a direct correlation between the kinds of degrees and curiosity, because you've got to be curious to be an angel. And one of the comments I make, I think angel investing is the best prophylactic for Alzheimer's that I know. Because they claim, and I'm sure we got some life science and neuro guys in the room, that the way to prevent Alzheimer's and dementia is to create neural networks. Can't sit here today, and I know we've got, 8 pitches coming up. You have 8 pitches coming up and not hear something go, oh, how in the world? I never thought of that. What a great idea. And that really was driving a lot of this. So proportionally, they've got business degrees, they got engineering degrees, but for those of you who are hardcore liberal arts, I'll tell you there's great hope for you. My undergrad degree is in Spanish, French, and linguistics. The only thing I was qualified to do was teach, which I didn't want to do, and marry a rich guy, and I was already married and I knew that wasn't going to happen. So you can do all this stuff without necessarily having an engineering degree. What we do know is that angel investors are entrepreneurs and executives, and disproportionately, they were an entrepreneur and then they became an angel investor. And this has real implications for angels and for entrepreneurs in terms of how you invest. Because entrepreneurs make a different kind of angels. First of all, they write bigger checks. If you've got an entrepreneurial background, your average check size is about $1,000. It's less for that, about $28,000 if you don't have an entrepreneurial background. You also take very active roles, okay? If you've got an entrepreneurial background, what you are given to the company is not just your money, because startup companies need much more than your money. They need to know what mistakes you've made so they can make new mistakes. No point in making the same mistakes we've all made in our companies, but they can make they take very, very active roles as a manager, as an advisor, in making introductions, because they know where many of the landmines are. That entrepreneurs, God bless them, are optimistic. If you weren't optimistic, you would never be doing this. But you need some of that advice on the other side. And why does this count? Because one, they invest in more company and they have more positive exits. And that's the important thing. So we see that if you've had an entrepreneurial background, you tend to have more positive exits. And again, that might also correlate to the fact that you're willing to invest in more companies, which again, and we know if you have a portfolio of companies, you're going to have more positive exits. How do people really get involved in angel investing? This is a people business. It's a friend knowing a friend. They meet, they talk to a friend, and they come to a meeting. If Mountain Venture Club is similar to what we do at RTP Capital, is we meet, the board in particular meets people in the course of our going out and talking, because we're very involved in the entrepreneurial ecosystem in the triangle. We then invite you to a meeting to meet other people. And very often, groups are the real introduction, because it helps you figure out, what is this? It's very, very different. We've got members of ours who have been investment bankers, and they've been in an M&A business for years. But they get to angel investing, and they can't run this thing on an Excel spreadsheet, because it isn't an ROI multiple. It isn't an internal rate of return. They need that group experience to make it work. And they invest in different ways. So, and this is the key chart where I says, I think the bias a little bit, this group was done primarily where we're seeing a slightly higher incidence of, but no matter how long you've been an angel, you tend to have involvement with groups. If you've been a newer angel, you are tending to use platforms a little bit more. But there's always, what I found striking is that the shapes of these charts, there's some nuanceable differences. There really isn't that different. Angels have a pattern of investing, and they do multiple things over time. When you look at how angels make investment, typically their first check the median is $25,000, and it truly does range from $1,000 to almost $1 million, okay? Follow-on rounds, and angels do a fair amount of follow-ons. It tends to be smaller checks, about 20 million. And again, the range is all over the map. There's no telling, okay? And when you look at the number of investments, again, we talked about the importance of the portfolio. On average, angels do 7 investments, okay? In the top 20, the lowest percentile, they do about 4. In the highest, they do 17. And truly, in this survey, we had investors say they did anything from 1 to 106. The guy's doing 106. I hope he's had some really good returns, though. I don't know exactly who he is, though. Okay? And this is only logical, okay? The longer you've been an angel, the more deals you do, the more checks you write. I think, one, you have more money to spend. Hopefully, you've had some positive returns. You've had more opportunity to see more deals. And so you grow your portfolio over time. You get to a point after about 20 years, we hear some comments from some of our members, particularly our older members, who will say, well, I don't want my investments to outlive me. So that means we got to get quicker turnarounds. But really, excuse me, people do grow their portfolio. And that's the way you should do it. I mean, one of the dangers you have, particularly for new investors, they'll go, oh, I'm in. I want this deal. I want to go in this deal. And I don't know if you, I see Peter shaking his head. We have this. Tell our new members, go slow. You don't want to take your whole portfolio of what you can invest in angel investing and invest it all in 1 year in one deal. So you really do want to grow this over time. Okay? The question is, what do angels want? And I'm sure a lot of them say, what in the world do they want from us? Okay? Well, it's real simple. They want more money. And when you look at we look at the results in positive exits. A positive exit is when you get back more than your initial investment. Okay? We all talk about the target for every angel. We want a 10x. Well, the reality is we don't get a 10x on every deal. If you get a few 10x's, it's sort of even out everything else. When you look at the percent of positive exits to their total portfolio, it's about 11% of all their deals. But we really look at the number of different ways. You will have, over the course of time, 3 kinds of companies. You've got companies that are just too early and they're not ready. So, if you've got a company that's 2 or 3 years old, you're probably not ready to have that exit yet. You've got companies that they are getting along, they don't have money, they're surviving, but they're not going to have a big exit. They're just going to keep going and going and going to some triggering events. If you get rid of sort of those, they're not exitable at this point. You then calculate this number, because if you would step back and go, wait a minute, I'm going to do all this work, I'm going to spend all this time and energy, and only 11% of my results is going to be positive. You go, I got to be nuts. Why would I be doing this? But when you really look at sort of the active companies and the right ones, you're getting about 40% of your companies are having a positive return. This is sort of your working companies. And that, so at least for me, maybe I'm rationalizing the whole thing. It's certainly a heck of a lot more palatable. That about 8% of my companies be returning. There are real differences in how men and women invest. Okay? First of all is the gender. Women very much will look at the gender of the founder. Okay? And particularly look and see, is it a woman? Okay? Men don't. I have a theory about this, okay? And my theory is the reason why men don't is because they don't even think about it, okay? I spent a lot of my career, I started out in financial services. In fact, many of you may know I was with First Data for twice, actually, for several years. I would be the only woman in the room, okay? I tend to look, and I often never have her name tag because everyone remember, Elaine's the woman in the room, okay? So it's not even something men think about. Women do, because it's different, okay? Social impact, okay, this is another key difference. Women care about social impact more than men, okay? It is a very important factor for them. And for those of you who are really awake, you'll know something odd about this chart. The numbers are actually inverse, okay? So unfortunately, it was a typo I didn't catch until we just got here. So women care a little bit more about impact investing. To me, that plays into a stereotype to be more applicable to the social impact of investing, but that's about the only comment I'll make on that. On the invest fundamentals, though, there's absolutely no difference. And there shouldn't be any surprises in this chart for you. Okay? What counts at the end of the day, investing is all about people. Okay? People. And angels care about the quality of the team. Are they knowledgeable? Are they upright? Do I believe they're ethical? Do I believe they're going to do what they do? And do they know what the heck they're talking about? Okay? And this is a really clear. If I'm an investor in a new business, I want to make sure he understands what this business is all about. And this is very, very consistent in terms of what the real goal that angels want. They want to know that I've got a good quality team, because all sorts of things are going to happen to the business. We all know they're going to pivot. And what we want to know is, do we have a team of people that can adapt to the change and still make us successful. When you look at the portfolios, what we see is that you tend to have more positive exits over time, okay? If you've got more companies in your portfolio, it's the law of averages, you're gonna have more success. And I don't know if the positive exits causes to invest more of their portfolio when investing, or if we weren't able to find that out, maybe in our next study we will. But we know that over time, angel investing becomes a greater part of your total investment portfolio. And I know when we talk to members coming in, we say, look, when you look at this, this is like any other alternative investment in your portfolio. You need to make a decision, how much of your total portfolio, how much of your total investment portfolio do you want to dedicate to this class, angel investing. So if you, and I'll make the numbers easy. You've got $1 million to invest. You want to take 10% into angel investing. So that means you've got $100,000 to invest over a certain period of time. This isn't just 1 year. Then how much are you want to do 10 deals? So that says basically you're going to invest in these initially $10,000 per deal. And that's the way you ought to think about it. Because the other thing about angel investing is you can't pick winners early on. A lot of the studies show you are much better off if you make a decision about what you're going to invest in a company. So it's a binary decision. I'm going to invest or I'm not going to invest. But then if you invest the same amount in each company, you tend to have better average returns because you're going to have a greater portfolio, and you truly, a company I thought in my portfolio, it's been hanging in there. I made the investment about 9 years ago, and I was worried that this was going to become one of my zombies. I got a call from the CEO one day, says, Elaine, I'm sending you some papers. We've actually got a sale. I went, oh, hey, good. Maybe I'll get my money back, okay? Busy. Suddenly, I open up an email. The transfer has come in. I'd made 15x. And others where I was sure to be my big, I was going to get totally faded away. So I think you got to, as just a way, you've got to be disciplined. And so I think as you get more confidence, why people that have done the longest investing have larger portfolios, it's because they have figured out how to do this and realize that it is a good investment class. Very optimistic story, okay? If you look at whether you're a newer angel, you're saying you're going to put more money into angel investing, okay? You like what you're doing more. We think the reason, particularly for the oldest angels, it's the case of, not that they don't have confidence in angel investing, but they're worried about angel out of their investments. So we will see future investment in angels and more activity in angels, okay? So this is really, this study is the first time we've done it. We will be repeating it on a regular basis. We want this to be our baseline. And the ask I'll make to every investor in this room, if you're doing any type of angel investing, when you get, you hear about this next year and we solicit you, please participate in the survey. Because having good data lets us make better decisions, lets us be better informed, and we can learn more about what we're doing. Some very positive things that came out of this. We are learning that angels are more diverse. They're in more places of the country. They're men and women. They've got a diversity of experience, which makes it easier and better for entrepreneurs to get results, okay? They like to see, and they like to do deals. I mean, there's a lot of deals. 71,000 deals is a lot of deals, and that's really important because you see a lot of things. And we all share the same common goal, which is to make that pot of gold even bigger at the end. That's it. What I'd like to do now is really open it up to questions. Thank you. Barbara?
Thank you so much. Thank you so much. Much of your data supports the imperative to engage more women investors. And we've got an initiative and we're making progress, but more slowly than we would like. What, in your experience, would lead to accelerating getting more women investors engaged?
It's two things. One, it's very much of a hand process, okay? It's I know somebody who then knows somebody who knows somebody else, okay? And that is, if you step back, it's really the same way men do it, but it's just we've got to be a little bit more conscious about doing that. Okay, first thing. Second thing, and I'm playing with stereotype now, women are afraid of asking dumb questions. I don't know, it's never held back men, but it seems to hold back women. And so one of the things we've done in the Triangle, for example, is I hosted an event about 2 months ago where we invited women who we knew were accredited investors, and this was a women-only event. We did it at someone's home with lots of wine, and we said there are no dumb questions. And that really, people said, oh, I didn't know about this, including a person who was starting some of the entrepreneurial networks in the area. She said, oh, I could be an angel, have the wherewithal. So I think it's a lot of, first of all, make it top of mind, be aware of it, and ask. Men will come, this again, and I'm playing to a stereotype, but women tend to want to be invited rather than invite themselves. So when you meet a set of women, when you talk about what you're doing, that is the best way of doing it. And it does sort of snowball on itself. Yeah, go ahead, in the second row.
Play within the investment portfolio. And what I'm curious is, for you personally, when you choose to mentor an entrepreneur, what qualities strike you? What stands out your decision-making process to say, I want to mentor this person or this company? More than just the angel investing piece, but the active mentorship.
I very actively mentor people. That's very important to me. They are committed as heck to their business. They really believe in it. They know what they're talking about, and they're willing to take advice and listen. Okay. I will admit disproportionately now, because there aren't as many women entrepreneurs. Part of the reason why I got involved in this was real simple. I have had every seat at the table. I was with large companies where I started businesses for the large companies. I bought small companies there. I then went out and I became an entrepreneur. I then helped VCs evaluate and invest in companies. I then sold a bunch of companies. So I really had every seat at the table. And I wanted to make it more visible that women could do this. And so it's why I speak, it's why I go out and do things. So women know they're not the only women in the room. Over here.
Hi. So I see a lot of the numbers, and I know that certainly trying to reach individual investors is almost impossible. 300,000 people is a lot to talk to in a short amount of time. With the Angel Capital Association, Rocky Venture Club, these are nice gatherings of people, but what do you think are the biggest differences between kind of reaching out towards individual investors versus a network, and why would you want to do one or the other, besides maybe that an individual investor may be more willing to invest in a bad investment?
Okay, I am going to show my total bias, so let me okay? I think for most, there's a bucket of what I'll call super angels, okay? These are people that tend to invest as individuals because they've had some successes, and every market has them. I'm sure you have them here in Denver, and they do it on their own. When you get beyond that, I think for most entrepreneurs, you are better off going to the groups, okay? For several reasons. One, it's more efficient. It certainly is a heck of a lot easier to talk to 20 people at once and talk to one at a time. Secondly, the worst thing you can have is an individual angel who doesn't know what you need as an entrepreneur, okay? You need a lot more than money, okay? You need connections. You need somebody to help you find that partial CFO that you don't have to pay for probably in the first little bit, and then eventually can know what law, you need to know what law firm to go to. A lot of individual angels, unless they do it a lot, okay, don't have those connections. And so the groups give you a lot more connections. Now, there are some groups that are as active as others. There are some groups that tend to be more tire kickers, and that's always a problem you worry about. But particularly, and I'll use an example here because I know a little bit about this market that I use in the triangle where I am, which is Raleigh, Durham, Chapel Hill. We have a phenomenal entrepreneurial ecosystem. And we have a group called the Council for Entrepreneurial Development that really brings everybody together and is a giant network. And my comment to an entrepreneur is that if you can't get introduced to the right angel or the right group, triangle, you aren't smart enough to be an entrepreneur. And here, I just heard about what, Peter was saying that Rocky Mountain Venture Club runs 100 events a year. I'm sure there's other meetups. I'm sure, whether it's in Boulder or Colorado Springs or Golden or all over here, there are all sorts of activity. If you are a committed entrepreneur, you can get connected to these. And you'll hear right away from your other entrepreneurs, when I talk to Rocky Mountain, Rocky Venture Club, this is what happens and the process works this way. When I talk to ABC, it doesn't work over there. So working groups, even if it's an informal group of angels, I think is much more efficient for entrepreneurs. Go ahead.
Hi. Thanks, Elaine. We get warned about trying to time the market in the stock market, that kind of thing. I can't help but think in investing as an angel about the next dip in the business cycle that's going to be coming. And I'm still in the process of building out a portfolio to kind of a critical mass. So any suggestions on how to prepare for that or critically evaluate companies interested in that? Thanks.
You need somebody much smarter than I am to figure out the business cycle, okay? Did everyone hear the question? How can you sort of look at the portfolio ways, maybe protect yourself against what we all believe is coming downturn? What you'll find is, one, I think diversify. Second thing is you can't predict it. Our company's going to be counter-cyclical or whatever. Third thing, which not a lot of angels think about, is to make sure you keep dry powder. VCs, when they make an investment, they might say, I'm going to spend, $10 million. Over time, I'm going to invest $10 million in this company. But they're not going to do $10 million in the first check because they know they've got to be in there for multiple rounds. So angels really, my belief is that you want to keep dry powder. So sometimes you get to a pay-to-play round or whatever, and you don't know what the business cycle when it's going to be. So you can't predict it. I would just say keep diversifying and keep dry powder.
Hi. So there were two statistics in your presentation. One was the number of minority investors that are in the angel group. So you meant. So that's very low. And you also mentioned at the same time that, if realistically, white men tend to invest in, so that it seems like there's sort of a chicken egg problem where you have to have, or the other part was you have a lot of entrepreneurs that become angel investors. So it's a chicken or the egg problem. You invest in minority-owned companies that are up and coming, so then they can become angel investors and invest in others like themselves. So then, as a first step, what efforts are you seeing to encourage in the room to invest in minority-owned, female-owned businesses?
Well, I think it's coming. I think in part it's a societal change, because you're absolutely right. It is this cycle, and one of the I just read a fascinating thing on that over 50% of the graduate students at American universities in STEM programs, so science, technology, engineering, and math, are foreign students from the United States. And that tends to be disproportionately Asian, African, other minorities, okay? So I think as we have more entrepreneurs, people are investing more because they're hearing more talk about it. You know, I mean, and I will maybe ask Peter, you know, how did it end up that half your portfolio as women entrepreneurs? Maybe it's because you all have a lot of daughters and suddenly you want to invest in their companies. But I think there is greater awareness of this issue. We talk about it now. We never used to talk about it. Now we're talking about it. And when we have a number, now we can move on from that. So I think, and it's always coming up and pressing people. And as you at least get one woman in the room, or the one, you know, perhaps African-American or the Hispanic, you ask their opinion and then you just push a little hard. So it's being mindful, I think, is the best way.
Yeah, I just wanted to actually brought that as well because we had a learning by doing pilot fund that brought together 99 women into a fund a couple years ago, predominantly white, but of our portfolio companies, 9 had women on the founding team, had female CEOs, and 3 had minority CEOs. So when we were looking at our new fund, we were like, how do we get more minorities in this? Because it's exactly that. The gap on the funding side is directly, you know, the racial and ethnic gap and growth entrepreneur side. So the way we get more high growth minority entrepreneurs is to have more minorities investing, entrepreneurs that get funded and become successful, then become the mentors, the advisors, the board members, the co-founders, and angel investors and VCs, and we get much more equitable ecosystem. So I'm happy to say that 26 of our 99 in our new fund are minorities.
That's good. That's great work. And again, I would say it's probably a lot from being mindful. I mean, I've made a conscious decision now in my own personal portfolio. This isn't RTP Capital. This is my personal portfolio. I am disproportionately investing in women, in minorities, and companies that have a social impact. Because there's lots of dollars chasing games, and I don't need to chase games right now. So as more people make those decisions, it will happen. And eventually, you know, we gain more and more momentum. And just talking about it is the first step. Any other? Yeah.
I'm just thinking of the bias in your sample and wondering how you could have more of what you label super angels in your sample size. Reach out to those. My gestalt is among my Asian, Chinese, Asian Indian friends that invest is that they don't show up in your sample. So, I mean, I just wonder if there are things that you can do to improve your sample.
We are trying to do that. We tried to do some outreach. We tried to do some outreach actually with the Wall Street Journal, just making you aware that you didn't have to do that. I think this will, again, it will build over time. Being the first study we did, as we get press on it, we talk more about it, and we tell everybody that this is our issue and our problem. We're going to keep working until we solve it. Okay. I'm sorry, am I missing? Okay.
Just curious, it mentioned possible ways of reducing the cost of capital for entrepreneurs as one of the topics. So what do you recommend as an entrepreneur versus the traditional way of just selling equity, when you're growing your company? Are there other means or methods for doing that?
Well, 2 things. First of all, contests, grants. You'd be surprised how many companies, because of the industry they're in, qualify for grants, whether it be science-based or, I was up with the EPA last year, and they had $1 million prize to solve a problem. And it was going to be pure, it was just money. No strings, no anything else. I also think equity investment from angels is not real expensive capital because they only win if you win, okay? And so if you pick good investors, think about what those investors are going to do for you beyond writing a check. Are they going to introduce you to the next client? Are they going to help you figure out how to solve a problem? You know, what value are they giving you besides just the money? Because money is fungible, but you need as an entrepreneur expertise more than you need anything else. And doing equity investing really does work.
Hi, so going back to this a little bit, rather than trying to make more chickens or more eggs, do we have a way to break that paradigm entirely so that we as investors are not biased unconsciously or consciously towards men or women or white people or minorities, and instead are just investing in good companies and good founders?
Well, I think the first thing is to recognize the implicit biases, okay? And I agree with you want to find good companies, but what's the definition of good? And I think the work that's basically been done in the last couple of years on implicit biases has helped open people's. I know I look at companies and I'll see X. The reason why I want my partners and RTP cabinet members to look at a deal is because they're going to see part of this deal that I'm not going to see at all. You know, they're going to see an opportunity. Maybe the companies that are doing X. And says, yeah, you know, you're doing X, but boy, you know, if you sold Y, you can make twice as much money. So I think more people in the city and acknowledge that, you know, do I have a Y I'm not seeing? And the classic one, you know, we've heard this example. Pinterest went to a bunch of VCs, and the VCs would not invest in them. They couldn't figure out how in the hell anybody, who cares? And by the way, how in the world do I make any money off of it? Obviously, the women in the room understood it, okay? And it's become a very good investment. So I think just recognizing that maybe there's something here that I don't see, you know, and I'm the first one in a meeting, I'll say, guys, help me out here. I don't understand why this is an issue or what the problem we're solving here. But somebody else will often tell me. So that's why having a group, I think, really helps, is the best finding those good companies.
Yeah, in your presentation, you gave one slide that had two different charts on it. One of them talked about knowledge and experience of the team, and the other chart said quality of the team. Help me understand how you distinguish those two categories.
Quality was having to do with more, are they ethical? Are they upstanding? More moral issues, ethical issues. Do I know this guy? You know, do I think they have a lot of initiative and grit? The other is, do they know their subject matter? You know, if you're going to sell to hospital operating rooms, you have somebody who knows how to get into, not that I'm going to sell to hospitals, but who the purchasing agent is in there. So it's, do they have the practical knowledge they need to make this business successful?
This is maybe less of a question than an observation. I came from the commercial real estate side of the world, which is predominantly male, and sometimes these things can seem like they're bashing all the white men, which I think isn't entirely fair, but it's a club. And so part of what you have to do is figure out how to get in the club to be successful, and that involves networking and getting into the room with the white men and actually talking to them. And I see a lot of times that either women stay away from those events, or if they go to those events, they sort of cluster over at a table to themselves. And so, you know, I just say, like, we all kind of have to make a better effort to talk to each other and start to get to know each other from not just, I'm showing up to ask you for money, because it's a long-term relationship building, and that requires networking and getting into the club.
I totally agree with you. What we talk about a lot is building a trusted community, okay? So, and you get, once you know people, it's amazing, you know, what you can do and what you do together. Investing is not a transactional effort, okay? We aren't doing transactions here. We are really building relationships. And I think that's a really important element, you know, particularly when you've got an early company, you've got everything going on. This is a lot like a marriage, you know, and so you better really like your investors. Yeah. One more. Who's the last question? Okay, well, I'm glad we could answer it. I will just thank you.